All three deals I've been a part of that were fraudulent have been referred to me by someone else who had a good experience. So just because it works for somebody else does not mean that makes it good.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
Welcome back, Tribe, to the Wealth About Wall Street podcast. We're going to be breaking down a topic called the truth about accredited investor status, what it means and what it doesn't mean. I'm sitting around with longtime coach, Mr. Downtown Ernie Brown. Good to have you on, Ern.
It is great to be back.
And also, we're bringing back the recovering CPA, Mr. Anthony Faso. Good to have you on, Anthony.
Excited to be back. It's a very interesting topic.
Yeah. Well, I definitely want to talk about this accredited investor status. What's changing? What opens up when someone becomes accredited, and maybe some pitfalls that might remain. For some people listening, they're trying to strive to get to that point. Maybe some have just gotten there and don't really know what it means. And for others, they didn't even know accredited status existed because they've always had it. So let's talk a little bit about, why this conversation is important. Ernie, do you remember maybe when you first hit accredited investor status?
Yeah, I do. I do remember that because right around that time, there popped up two events that I wanted to go to and could go to because I had the quote unquote status to get in the room. One, Russ, was our very first passive income mastermind retreat. That was pretty cool. The second was this it's like think tank event, Business's Mission here in Birmingham, an event for companies who are seeking early stage funding to come in and pitch at an event. And then they had like a closed sort of backroom meeting, if you will. And I remember going to those events and just getting exposure to the conversation and to the deals and the deal structuring that I wasn't able to hear anywhere else up to that point. So yeah, I do remember that.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to what'swhatwallstreet.com/PIOS.
Anthony, what about for you? I know that you've been accredited for a long period of time. Do you remember kind of the first experience and maybe what changed for you?
Well, I remember before when I first heard about what an accredited investor was, and you know what, it was not me. Like my first experience, I wasn't in the club per se, which was frustrating. But then when I did finally reach that milestone, I would say, to me at least, it was a little honor to being able to hit that milestone. And then that really opened a whole slew of opportunities.
Well, let's talk a little bit about what it takes to get the members only jacket here, right? So correct me if I'm wrong. The status, in order to become a accredited investor, you need to make $200,000 a year for the last 2 to 3 years. If you're a single filer, or if you're married, you can combine incomes and have a household income of $300,000 a year and anticipating continuing to make it. Or you could have a net worth excluding your residence of at least $1 million. Now, I know there's a couple other little things. I think if you go and take a certification, you might be able to become like a financial advisor or something like that. You can qualify for it. Did I miss anything from you guys?
No, I think that's about it.
So you could be a bank or an insurance company.
Right.
Have a certain amount of assets that qualify you.
So talk a little bit, Ernie, about, kind of what does this accreditation actually allow you to do?
Yeah. Well, it gives you, there's two sides to it. There's people with deals and people with money. So for the people with money, it enables them to be able to get access to deals because they qualify, that the other side deal makers are able to put together and get an exemption from the typical SEC regulations. So they get to make offerings for projects that qualify without registering it as a security. And the accreditation test or qualification it tells you who can invest in those deals.
Anthony, talk a little about from the deal sponsor perspective how accreditation affects capital raising or maybe investor communication.
Well, it affects it in many ways. Well, for one, when you're this is the whole security laws and rules that we're not gonna get into. But depending on what type of or how they structure it, they may be able to allow a certain amount of non-accredited investors, or they may just only be able to accept accredited investors. But by doing that, by having that narrowing of their prospects, does minimize how many people can actually participate in the deal. Also, there's limitations on how they can market. They just can't run an ad or do something open to the public. So there's a lot of obstacles that it takes for the syndicator to be able to get access to clients and capital.
Yeah, and just for those listening, if you may not even care about this, but there are rules governing, as these guys have already said, of which sort of investments you can get access to. So the one that's kind of like a private invite only, we're like thinking about this like a party, private invitation. Those are going to be ones typically that are available to non-accredited investors. If they can come on a podcast and do a webinar, get on a stage and talk about the investment, that's going to be kind of like the big public party. That's going to be something where everybody's available if you're able to, get the jacket, right? If you get the members only jacket, you can get in the club, but they can talk about it to anyone. Just the only people who can invest in it are people who meet that criteria. So, Ern, let's talk a little bit about some, myths that exist around this subject. So what's a common misconception maybe that high income earners would have about private investments once they qualify?
Yeah. The myth that I've seen people make just talking to them is when they started evaluating deals and looking at the returns, oftentimes people are putting together syndications and the investors are looking to become limited partners. And those types of deals often offer a preferred return. And I've seen investors mistaken the preferred return as a guaranteed return. They'll talk about like it's a guaranteed 9%. And then on top of that, I could get more if XYZ happens. And nobody likes breaking the bad news, but I hear it over and over from investors.
What would you add to that, Anthony? What are the sort of misconceptions do maybe people who become accredited, start investing, and start qualifying have around these sort of investments?
I think the biggest one would be that they're all high risk investments.
So that's not true?
I wouldn't say that they're all high risk. I think there's some added risk and I think there's some truth or some benefit of having this members only jacket. So it does protect some people, but this does take an additional, I would say, a layer of education and due diligence that maybe may not need to be done if we're invested in Wall Street or more of a traditional security.
Well, I would like to address some of this. So what we're talking about a lot of times are investments that are not going through broker dealers, right? Would not necessarily be something that would have to go through a level of scrutiny or whatever as like an Enron, or WorldCom or something, as strong as like in Alabama, we had a Health South, something that had to be like heavily scrutinized. It couldn't have gone bad. There's no way someone could have like cooked the books and you invested in something that becomes a fraud. None of that stuff, like a Madoff kind of thing, like none of that stuff could be available to you, right? Obviously, I'm tongue in cheek as I describe all of these entities that had all this fraud. But there's a level of scrutiny that those publicly traded deals go through, and not that they can't have issues with them, but in the private sectors, right, there's less oversight. And so there are opportunities. So for some people, they would say that they're higher risk. For others, maybe they're equally of equal risk. I think another thing that needs to be discussed is whether or not, should people be able to invest in them if they're not accredited, right? Like some people don't meet that accreditation and feel like they're being left out, but yet they don't want to invest in the traditional markets. They don't want, to do the stock plays, but there's not enough of these private dealings out there that they can get involved in. But what's your just baseline opinion upon that, Ern?
Well, I'm hung up on when Anthony threw out the word risk, whether it's high risk or low risk, that just rang in my ears, and thinking that traditional Wall Street investing, whether you got yourself a little brokerage account and you're gambling your money, picking stocks, and thinking that that's lower risk than investing as an accreditor investor in somebody's deal, I think that is dangerous if you think that way. So that rings in my ear. But man, I also think just have seen many people deals go really well for them. They're investing as an accredited investor in one of these offerings, and it go really well. But I've also seen many people where those deals go bad, both with things that I probably could have picked out, but also things honestly that I wouldn't have seen coming. Like we've seen interest rates rise pretty rapidly a few years ago, and that put a big hurting on a lot of the major real estate deals that have been happening. Commercial, multifamily, those types of things have really impacted and have just seen some people in our community not think to evaluate the interest rate risk or what the structure of the debt is in that deal, not know to ask questions or how to sort through it or think through it. So have seen both the good and the bad, and so have learned enough to say it's not really whether the deal is accredited, therefore it's a good deal, or if it's available in the public markets, if that means it's a bad deal. I mean, not necessarily that's the evaluating point. I think it's more has to do with the person and their ability to evaluate rather than the deal. And I think when we look at these guidelines and these rules, I think it absolutely swaps the emphasis.
Well, I think one of the things that we have to consider a lot of times in the public markets, there may be a number of hands between you where you're putting a dollar in and actually the result of it. And just like anything, right? The more overhead, the more people between you and the actual deal, the more dollars have to come off of it. So less return ends up in your hand. So how do you measure risk? How do you measure risk adjusted return? That's where my, skepticism of the traditional public markets are, is that I don't believe that I can invest a dollar and get enough return equivalent to being able to invest it in the private markets, because there's just too many people taking a cut of the pie. I used to be one of those people. I used to, take my 1% management fee. There was a company that, was taking a third party management fee. There was another party that's taking a fee. There's all these fees being taken out, and it's hard for me to get at the end. I'd say another misconception in here is that, deals won't come around again. I think people oftentimes in the private markets, they get exposed to this idea of investing in syndications. They're all excited about investing off of Wall Street. They see the first deal and they do their first deal. And maybe they get lucky, right? Maybe it's successful, but oftentimes they have not had enough time to evaluate what is a good deal versus a bad deal. They haven't built their investor DNA and investor buy box. They haven't really equipped themselves with the proper due diligence skills, because it is a skill, it's a learned process. And while you can learn this information, it isn't until you start understanding it through experience will you truly start to gain more mastery over it. So yes, there's opportunity for you to make mistakes. And as a result, we may lose money. But I do think because we're able to get potentially higher returns out of some of these transactions than we would in the traditional public market space, I believe for me, it's a better deal. All right, I want to jump over here to more strategy over status. So talking to you, Anthony, just because you're accredited, does that mean now you're ready to start investing in these private transactions and syndications and other things that require the jacket?
Just because you're invited doesn't mean that you should go to the party. And I think that again, like we're big proponents on invest in what you know. And that's part of the problem we see with traditional investments or Wall Street. People have no idea what they're investing in or what's behind the company. But to me, I think just because you can doesn't mean you should. But what you should do is learn about it, do the due diligence, find your buy box, and figure out which of these deals are going to fit into your short term and long term goals.
What about you, Ern? Jump in there. Like, do you feel like there's some areas where people need to tread into this lightly or with a lot more skepticism?
Yeah, I would say tread lightly, act act skeptically. uh, if you're alone, you're probably wrong. There's a saying out there that when I see isolation, I fear violation. So, how many of us are making the transition from Wall Street based investors, where we did it with very limited direction from financial advisors? We just sort of tried to cost average in and tried to diversify immediately and move to wanting to create income streams. And so now we're looking at a multifamily project or a car wash or whatever the case is. And we don't have the people around us to call upon to vet opportunities, and we're doing it alone. So yeah, Russ, absolutely tread lightly. But also we've seen probably the worst thing of all happen, which is that we've come across some deals where they've looked good, they've sounded very promising. The group's even our group has evaluated them. By our group, I mean our community, and many people have chosen to jump into those deals, and then it turns out that it was fake, that there was fraud going on, that what was being said was happening wasn't happening, that the equipment wasn't real, or that the way that the money was performing wasn't real. It turned out to be a Ponzi scheme. There was water, there was money just falling down. They were taking it out of one person's hands, putting it into the next. And that's it's kind of hard to evaluate that even as a group. So you do have to be cautious. But Russ, as you have shared many times, just from your own experience, you've learned to just some of those warning signs to avoid fraudulent deals. And maybe you could share just some of what you have shared with me, what you've learned by that.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz. Wealth Without Wall Street Tribe, do you want more ways to build wealth and live free? Then you've got to check out the Lifestyle Investor Podcast with our friend Justin Donald. He's interviewing top investors and showing you how to design a life on your terms. Check out the Lifestyle Investor Podcast and subscribe today.
I've learned way more than I want to learn in this area, right? How about I've experienced way more than I want to experience in this. I've seen 3 fraudulent deals personally. I think a little bit around this that you have as you're coming out of this public markets where typically, you invest in something, someone else has a good experience, they share their good experience with you. Oh, you need to get in this stock, you need to get in this fund, right? Like that's what we're used to. And they've had a good experience, so you anticipate you having a good experience based upon theirs. And then we equate that into the private markets. Oh, Anthony had a good experience with this one. I can remember an experience where Anthony had a personal experience that was good. He told me about it. I was like, oh, that's cool. I will do that too. It ended up being a fraudulent deal, right? So an example of a good deal that someone else had an experience, and I equated, oh, I don't need to do quite the due diligence because my good friend has already done that. Well, maybe Anthony did it on the front end, but didn't mean he continued to do it, right? I've seen that continue. So there's a thread there. One of the things I've understood is that no matter what you're investing in, you personally need to be able to inspect what you expect. And if you don't know how to equate whether or not this is a good deal for you, Ernie, you were saying this before too, like what's the value proposition that is bringing to the world? Need to understand that. Need to understand why is the return equivalent to, why are they giving me the return? I think sometimes the mistakes people make is they get into deals that have returns that are higher than the market average. And what I've realized is that the market does not need to pay high rates of return. The syndicators, the capital raisers, the people who have consistently produced over and over and over again, they don't have to pay 10, 20, 30% returns. They just don't, because they've got people that are all excited to give them money at 6 to 10% and will continue to do it if they keep hitting their numbers. So the higher the return gets over that, a lot of times there's some level of risk that's being inherently taken, either because the operator is not maybe experienced yet, or maybe there's some opportunity for loss in there, whether it's full or zero. And I think that that's what my eyes have gone to, is that I need to better understand the return to my capital equation. I need to figure out why would I get a better deal than someone else. I also need to be able to do my own due diligence, regardless if someone else is having a great experience, because I've gotten, all 3 deals I've been a part of that were fraudulent have been referred to me by someone else who had a good experience. So just because it works for somebody else does not mean that makes it good. And I think that that's part of what I've had to learn. But let's dive into maybe some of the tools that can help people, maybe some of the filters that can help them avoid that emotional decision, right? I think emotion gets in there, and we justify things logically through our emotions. Anthony, what would be some of those tools or systems or filters maybe an investor could use to help them avoid making some of these riskier decisions?
The biggest thing that has helped me evaluate deals using more logic as opposed to emotional, because you could get on the phone and you can see a fancy pitch deck, or the person on the phone is real smooth and comforting. You feel a connection. You do need to take a step back, and what we've built through the passive income lab, what was a buy box, just to know so I can filter through these deals, and I can filter them through my buy box, and that independently tells me where it fits and then where it does not. So that the buy box would be the number one tool.
Ernie, I know you like the buy box. I want you to comment on that. I think maybe what should go in the buy box, but then any other tools or filters that you feel like would be good for the listener.
Yeah, I agree. If you have no expectations, you'll wake up with anyone. So the buy box can become the criteria that you use to apply to the deals. That we've built a technology that builds that out, and as Anthony was explaining, it does it forces you to match up or to evaluate based upon some set criteria. We fall to the level of our systems. So if we have a system, we're in good shape. If we don't have a system, we wake up in a world of pain. So part of that buy box too is not just figuring out if the deal is a good fit for you, if it fits your criteria, but also in the buy box can be criteria that you have developed to tell you at what level should you participate in that deal. Because our at least my financial circumstance is constantly changing. So I've set some thresholds for how much cash I need to keep in reserve for my family, for each business activity that I'm in. Do I make sure that I have clear and set aside dollars for the taxes that are coming due that I'm needing to set aside? I mean, you don't want to invest those dollars and then get your tax bill and realize that, oops, should have probably kept that money back. I think we've probably all heard that story before. So reserves, but then also based upon where you are financially and your income and your passive income and how many deals you've done, what percentage of your capital or what specific dollar amount are you willing to put into any one deal? Have you evaluated that? That way, when you do talk to somebody on the phone who you make a great connection with, or the pitch just seems incredible, the opportunity of a lifetime, you don't accidentally oversubscribe yourself into the deal because of emotion. Again, you can fall to the level of your systems, and you can only do that if you've determined those types of things before you get a live opportunity in front of you.
Yeah, that buy box, figuring out, what types of assets you want to invest in, if there's specific regionality to them that you're, going to limit yourself to. Are you going to invest in people? Are you going to invest in processes? What are the due diligence questions? Do you have them all? And if they don't answer the questions that you want and can't get the answers, are you going to say no? Like to your point, Ernie, what is the capital requirements that you're willing to get involved in? How much of that are you willing to put in any given deal? I love, asking the question when I'm, going through this process, especially in the accredited investor space, this private space, is asking them, tell me how I can lose all my money, and letting that be the iceberg question, letting that be the one question that leads to all the other questions, because whatever they say off of that gives you questions to ask from it. And the further you go down that train, the more likely you are to really understand the risks involved and understand the competence of those who are, talking to you. And maybe you're talking to the right person. Maybe you need to talk to a different person, and that always shows itself, because sometimes you feel like I've been in one deal where I thought I was investing in an operator, and turns out I was investing and a capital raiser. They had a management company for the asset that they were dealing with. And so when I thought I was really secure, I ended up not being as secure because they didn't know all the details. And I didn't even know that I did know all those details, because I thought I was invested in that person. I want to switch as we start to wrap this up, because obviously we utilize infinite banking in our, passive income operating system to complement everything that we're doing. So Anthony, I'd love for you maybe to share an example of how infinite banking has helped you or one of your clients stay ready for some of these deals that come across.
I mean, there's so many benefits of infinite banking, but to me, the biggest benefit I've seen with me and my clients is being in a position of liquidity. Oftentimes, I mean, we're doing the traditional route, everything's in our 401k and everything's wrapped up. But with infinite banking, it has allowed my clients to have access to cash. So then they can evaluate these deals. And also, some of these, you know, one thing I like to say, the bigger the opportunity, the smaller the window to take advantage of it before somebody else does. So oftentimes being able to quickly assess a deal allows you to, and you have the liquidity, allows you to confidently take advantage of these opportunities. And that's, to me, is one of the many things infinite banking does. It allows you to be in charge of your capital.
Ern, the same question for you. How would infinite banking you feel like complement the credit investing space?
I think it simplifies the picture. There's enough to do when you're evaluating a deal. I mean, that's really the game. You don't want to be constantly in a stress position trying to figure out, well, what's my mechanism for getting cash? I've got all these different little accounts, and I've got 7 different self-directed IRAs set up, and this little bit of money squirreled away in a brokerage account and this high yield savings account. And so what order do I need to go to get that money out? For me personally, over the last 8 years, building capital in a few insurance policies has made things really simple and really clear. It's easy to count my money, if you will. And that's been good for me, but it's also been good for my wife, because have a clear personal financial situation when it's time to do something. And she constantly wants to know if it's quote unquote safe for us to do it. I can always point back to our liquidity requirements, our cash reserves, and tell her and show her at times when she needs to that we do have the money set aside in reserves, and we do have the money built up over and above that, sort of our opportunity bucket space in the insurance policies to go put to work. And the second thing is this: how deflating is it if you've spent years and years and years accumulating dollars in retirement vehicles that are intended for this, and you sell your positions of those to do one of these deals that require accredited status, and the deal go on a long-term pause, the capital distribution stop, or the deal go bad. And now you've gone from, I had this money and now I'm looking at losing this money. I mean, that is deflating. But for me, one of the comforts that I have is I almost feel more freed up, not to take greater risk, but to be more comfortable with risk, knowing that the dollars that I've put into insurance policies, that principal is protected and is always growing. And as I leverage that by using the life insurance company's money, I do want to put it into the same places to expect the same returns that I would anywhere else. It doesn't change that. But if the deal does go bad, I know that those dollars are ever growing in the insurance policy. And over the next several years, I could find ways to replenish that and not have lost ground. So it simplifies and gives me better encouragement to take the same risks that I am now.
Yeah, no, that's great.
Russ, while Ernie said that, it kind of triggered another advantage. And what I like about infinite banking is a lot of times if we're just sitting on cash, a lot of times we could be in a hurry to go ahead and invest it because you're just rotting away, barely earning anything. But with infinite banking, I know that I can take my time to find the right deal for me. In the meantime, my cash is growing and it's tax-free and asset protected. But what that also does, it allows me I now have a higher benchmark before I'm going to deploy my assets. Because if I'm earning, say, 4% in my policy tax-free, let's say that's 6.5 or 6, I'm not going to jump at a 7% or maybe 8% deal because I'm not really want to take on such a small risk or take on that risk for a smaller return. So that's allowed me to be a little more picky for when I do an investment.
Well, that's a good point. I would say as we wrap it up here, just a couple like rapid fire things. I feel like the mistakes sometimes we have is that we don't have a circle of people around us that can help us evaluate deals, right? People that we feel confident talking about money with. That's the hard part, right, with our friend group sometime is that maybe we make a little more than they do. Maybe we make less than what they do. And as a result, or maybe we're investing in alternative assets and they're investing in the public market. So we just can't have the same conversations. And, I keep seeing this, quote around is that you can't change the people around you, but you can change the people around you. Right. And having some people in your world, whether it's in a mastermind, if it's in a community like this, people that are doing investing, that when you have an opportunity, take it to them, have 2 or 3 sets of eyes that look at it critically before you say yes. Right. A friend of ours has a funny saying that says, when a deal seems, like a no-brainer, get a second opinion. Right. Like it's those moments that when you're just so ready to say yes, go ahead and get a second opinion from someone else who's doing these sort of investments. So I caution you, don't go ask someone who's not doing these sort of deals to get their opinion, right? Like that's what happens is whenever you go ask, your advisor about infinite banking and they're wanting to invest your money in the stock market and put assets under management so they continue to get fees, how likely are they who have never bought a whole life policy, much less taken a loan against it and create any cash flow? How likely to tell you yes? Why would they tell you yes? And what sort of opinion could they give you that would make you feel good or bad either way? But you should go and talk to people that are doing the thing that you want to do and then get their feedback. They may say, yeah, that's an amazing deal. I need to get involved in that. Or, you know what, here's here's the issues I have with it. I would ask these sets of questions, or I would totally avoid it. You have some feedback loop that could help you. That would be just one of those final filters I would want. Ernie, what would be one other one for you?
The one other that I would add that's timely, because I was on on a new conversation with somebody who'd come into our world. By the way, in a pretty interesting way, he met Joey down at the beach. I think that's the first time that's ever happened, which is amazing considering how much time Joey spends down there. But Joey met this guy, and I had an opportunity to connect with him, and he was fairly new into this world. He's making the transition from just as somebody had a long career, looking to accelerate his financial progress forward, because what he had done up to that point, he's doing fine, but not getting him everything that he wants. So he needs to do something else. So he's starting to look for deals, and he got connected probably by a friend. I can't remember how he got into this group of a capital raiser. This guy's job is to meet people and bring opportunities. And so he got on the list, and a couple months later was sent a deal, and the terms of the deal was this. It was review this deal. It's Wednesday, and I need your capital commitment by Sunday. And so this is his first opportunity to look at something with a short amount of time to make a decision upon it. And Anthony, like you said, maybe it's a tremendous opportunity, so the window is really short, but he was feeling the pressure. And so I didn't look at the deal, but I asked him these questions, Russ, to your question. I just asked him how well he felt like he was able to understand what the deal was and how it worked, and what the value proposition of the deal was. Like, how does this help? What problem does this solve? How does it make money? And how's that a good thing? Is that in demand? And then how well did he understand the language in the deals and how it was structured? And how had he considered how much capital he'd be willing to put into any one of those deals? And how many of these types of deals had he looked at before? And, the answer was no and none, all those questions. So, my consideration would be, when you're getting into this world, it might be wise to not invest in the first deal you look at, which sounds it makes a ton of sense. Coming into my ear, out of my mouth into my ears, that makes a ton of sense. It's logical. But I cannot tell you how many times I've seen the stress and the pressure, and fortunately some of the success, but I've also seen the failures of people who wish they had taken a little bit more time to learn to evaluate, so that when they do lose money, they felt like, well, at least they made an educated decision. And when they do make money, they're in that much better position to go do it over and over.
Yeah. And by the way, when you make money and you are making money, don't fall into the trap of assuming that it's still good, right? Like, I had that conversation with a guy today, is like, hey, if you've been investing with somebody for 3 to 5 years, it's been working well, still inspect what you expect, right? Because anything can happen in a business cycle, a personal situation that can adjust the way things are being done. So keep inspecting it, so that way you're not surprised if something changes. And then as a result, your money is now being put at a greater risk as a consequence. Anthony, final question for you. What's a question no one asks, but everyone should?
Most of these deals are going to be using leverage, or they're going to be using bank financing. And to me, an important question I ask is, what are the terms of those loans? Oftentimes, or sometimes, it's a short-term loan, maybe for 2 to 3 years, and they assume they're going to refi. But what happens if they can't? Just like Ernie had mentioned a couple of years ago, interest rates shot up. Anybody who had anticipated being able to easily refinance once the asset was fully built out was in for a rude awakening. So one question would be, what are the terms of the financing? And if the plan is to do a refinance, what's plan B if we're unable to finance?
Very good. Well, as we've talked about today, being an accredited investor doesn't make you elite, doesn't make you not, but having good strategy, having good stewardship, having community definitely is an upgrade that you can add into your quiver there. I would love to point you to these investor buy box, investor DNA tools that we have. You can go to wealthwithoutwallstreet.com/resources and get access to some of the ebooks around those. Also, if you've not created these and you're looking to, hey, how do I get this first $500 a month in passive income? And you want to be a part of that passive income lab that Anthony was talking about, go to what'swhatwallstreet.com/free call. And one of our coaches can talk to you about what's required and, how that process works. And is that maybe a good step for you? If you're an accredited investor and you're looking to start getting your first $500 a month in passive income, and you're like, hey, I'm looking for a simple deal to get a part of. Actually, you can go to, you can send an email to info@whatwhatwallstreet.com. Actually, we have a fund. It's a debt fund. We are buying businesses right now. We're using the revenues of the company that we have already. If you know, like, and trust us and want to participate in that, we can give you those details. If you're a accredited investor, just go to info@whatwhatwallstreet.com, put subject matter investment opportunity, and can set up a meeting, give you those details. Gentlemen, thank you so much for coming on and sharing your insights. Good to have you back, Anthony. Thank you again, Ern, and thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.